Off Limits is the money podcast that blows up stereotypes, showing you that managing money doesn't have to be hard.
We want you to thrive, not only with your money, but in every part of your life.
What you will get out of this podcast is real, relatable, and relevant tips and strategies that you can apply today. Hi, I'm Donald Raymond, and this is
Christine Spiak. We are money coaches, business owners, and colleagues who are passionate about helping you become more of who you are. So if you're ready, join us. We have to start saving for the down payment.
So we're going to save money.
Yep. And if you don't know, if you don't put down a 20% deposit onto the home, then you have to pay something that is called PMI. And it's something mortgage insurance. I'm forgetting what the P stands for right now, and I know this because we did it when we bought our first house. We did not have 20% to put down, but we really wanted to get in a home and we didn't want to wait longer to save more money. So we paid the PMI until you reach that 20% of the principal. And then that insurance, that fee that you're paying every month goes away. And you're paying it because the mortgage company is saying, okay, if you couldn't put down 20% on this home, are you really going to be able to make the payments every month, keep up your end of the bargain? So until you show that you can and you make payments on time and you get to that 20%, you're going to have to pay it. Then once you do, they remove it off of your mortgage payment.
That's right. Yeah. So PMI, private mortgage insurance, you're self-insuring. You are paying your own way. So you've now made a decision. Let's unpack that just a little bit. We've now made a decision if we chose to enter into this agreement, Christine, on buying a house we can't afford and taking on a payment that's too big, paying interest now on that payment for 30 years. That's the typical schedule, right? They actually have mortgages now. I don't know if you know this. They go beyond 30 years. And so they'll lend you money for the rest of your life, effectively. And the interest on that money is going to be astronomical. If you run out the 30-year amortization on most current mortgages, you're going to have bought your home 4 times by the time you pay it off. So that's a little discouraging, right? And I'm painting a negative picture on purpose because this PMI, this private mortgage insurance, if we enter into that agreement, not only do all of those variables apply, but we, like you said, we're telling the mortgage company, we can't probably afford this and we may default. And so now you're also going to pay another payment and you're going to pay that to a private insurance company at a premium so that when you default on this loan, any missed or due fees and payments would be covered by that insurance. Now, being covered by insurance makes it sound okay. And there are certainly insurances that we want to have, life insurance, health insurance. But this is not one of those insurances that's a good thing. This is one of those things that if you hear it during preparation, during shopping, and during getting qualified for a mortgage, if you hear this term, PMI, private mortgage insurance, or just the word insurance, walk away. Go find another option. You do not want to enter into that agreement. And if you're in a position, like Christine said, where you can't put that 10, 15, 20% down and avoid the PMI, everybody's got kind of a different threshold out there, then you aren't in a position. We're going to tell you you're not yet ready to make this purchase. And so definitely saving first. Where would you recommend if we're going to save, Christine, what kind of account would you put that in?
A high yield savings account.
A high yield savings account. Okay. What does that mean?
So a lot of online banks have something that's called a high yield savings account. The one that we bank with has a 5.25% interest rate, which is, well above what you're going to get at a local bank or credit union. Any kind of brick or mortar financial institution can't even compare to those rates. Other people may tell you to do other things, maybe put it in a CD, maybe invest it in the market and then take it out when you're ready to use it. But a high yield savings account is a great, safe way and a great place to start.
Yeah, no, I agree. And a lot of banks, if you're just dealing with a brick and mortar bank, their version of a high yield account might sound something like money market account, right? They're going to offer a savings account that's a little bit higher yield, but it will not, you're right. In today's market right now, high yield savings accounts are available and we should take advantage of them. Now, will they be around forever? They're not going to be around forever. They're not sustainable. The market conditions keep changing. We said the real estate market is a function of that. So if you're, again, we told you that we're recording this November 1st of 2023. And so if you're looking now in the winter of 23, you do have the option for a high yield savings account. So you may as well take advantage of it while you can, because you will have hopefully a fairly significant amount of money in this account once you start saving or move over any money you've already saved into those accounts. And like you said, It's probably not at a brick and mortar bank. It's not going to be at your neighborhood bank around the corner. These are online accounts, and they are safe. They are FDIC insured, and they are offering through different strategies that they have. They are offering some higher yields because they're taking advantage of market conditions as well. So the fact that they can insure that money is great, and the fact that your value on the money increases is also great. So instead of paying the interest, they're now
You're
paying
earning it.
you the interest, and so that's always the relationship we
like
want. And
that.
if you
We
think
like
about
that.
it, if it was going to cost you 5%, but you're now making 5%, it's not making 5%, you're making 10% because
Mhm.
the options on the table are cost yourself 5% or make yourself 5%. So the difference between the two is actually a 10% benefit.
Yes.
Yeah. Thank you for joining us on this episode of Off Limits.
Beyond the podcast, we are money coaches who want to help you.
So if you are looking for help managing your money, use the links in the description below to contact either of us and learn how coaching can help you thrive.
Lastly, please help us to spread the word by subscribing, leaving a comment, and sharing our podcast with your friends and family.